Hey everybody, welcome back to For Starters. Today we're going to pick up one of the themes that we've talked about a couple of times in recent months around just the state of venture capital and some of the things that are going on. And the angle that I want to share with you today is a divergence that we see happening even within the venture industry that's separating a very small group of funds from the vast bulk of the managers in the industry. And that is leading to some very interesting effects on the space. So just to recap some things that we have talked about before, it's been a challenging 3 years for venture capital, and that is coming into having an effect on not only the underlying portfolio companies, but now at the manager level of the venture capital firms themselves. Of course, startups have been struggling to raise money since mid-2022 when the interest rates were starting to rise, and they've been through, so far a couple of company fundraising cycles. If you assume most companies raise for about 18 months worth of capital, even if we've seen companies kind of starting to move more towards the idea of profitability or better unit economics and more longevity and reduced burn, it's still, roughly 18, 24 months, which means companies are now entering the third need for capital of this downturn. And look, at the beginning of this year, I think a lot of us felt like the dawn was going to be breaking, and that mergers and acquisitions and company sales exits were going to be returning to the venture capital sector, which is critical, right? If you really boil it down, what do venture capitalists like me do? We partner with entrepreneurs to create a startup that eventually becomes something that is sold. And then, hopefully we as investors, the founders, their teams, et cetera, make money. We've contributed something to the world that has found a buyer, public markets, strategic financial buyer, whatever it may be, and we can recycle that capital from our LPs back into the next generation of companies. That, in a nutshell, is what we do in venture capital. And the exits have been few and far between. As we all know, very, very little IPO activity, M&A in general at a 20-year low at the beginning of this year. And yet we felt like maybe, regardless of how you feel politically, that the deregulatory, lower tax type environment that we might have expected given the change in the White House would lead to a much more robust liquidity environment. M&A would return to the space, and that would be good news, narrowly speaking, for venture capital firms and our LPs. That has turned out to be not the case. Partially responsible for this would be the general economic discomfort and uncertainty around the tariff regimes and the other uncertainties that have come to befall the financial sector for the last 6 weeks. That has led to actually a cooling even further of the M&A markets and kind of stopped everything in its tracks. We've seen a lot of deals really calm down, cool down. And that begins to create a dynamic of haves and have-nots in venture capital. So I'll give you an interesting example. Venture capital fundraising hit a peak in 2022 of just under $190 billion, the most new money ever to go into venture capital firms writ large hit at that point. That collapsed in 2023 to below $50 billion and then recovered last year to $72 billion. But wait, let's scratch and sniff that number a little bit and see what's underneath it. 72 billion actually breaks down to about 52 billion going to roughly 35 or so venture firms at the top of the market. So of the 72 billion, 52 billion goes to those firms. About 11% of all venture dollars raised last year went into the hands of Andreessen Horowitz, A16Z, which left $8.5 billion that went into new managers, emerging managers, and only about $7 billion that went into the hands of all the rest of the existing funds out there, of which there are about 10,000. And if you spread $7 billion amongst 10,000 managers, that really doesn't work for the industry. It's just not enough capital. And so what you're seeing is downward pressure on the vast long tail of venture managers. Makes it harder for them to support their companies at a time when their companies are needing to raise more money, which then also depresses the kinds of financing those companies can raise. So you see a lot more bridges and extensions moving into recapitalizations, and that damage is lasting on these companies. It depresses the incentive of the founders to work. It makes the cap tables more complicated and tougher to finance, and ends up looking like damaged goods going to market. And so there's a real effect of this kind of tale of two cities happening. So you can have, Andreessen Horowitz mark up Adam Neumann's flow, for example, today, and kind of mark that up and give themselves a double. Now, I don't know the underlying economics of flow, but it is interesting that the prior lead investor is once again pricing that deal, and it's a lead investor that is virtually price insensitive because of the amount of capital they've been able to raise. And meanwhile, the vast long tail of venture capital firms in the market are struggling to figure out when and if they're going to be able to go back to their LPs to raise more money, because in fact, the LPs are looking for IRR and DPI, that is to say, investment performance and dividends returned to them. And those two things are in short supply given the market. So right now, I think it's something that we need to really track to understand the health and longevity of the venture industry. I do think if we remain in this kind of, nuclear winter of no exits, it's going to start to get dangerous, not just for the startups, which have already been struggling for a long time, but in fact for venture capital firms themselves, any but that handful, few dozen of the firms at the very top of the market. Now, the question is, of course, is this a bad thing, right? And the answer is, in my opinion, it's not great. And that's not that I begrudge these large firms from raising as much money as they can. That's terrific. And it's really good to have some very large firms that folks can look to as an example that have a lot of strength and longevity. But here's the thing, especially as you look at the early funding of new startups, the priming of the pump, as it were, a priming of the pump that's going to get more difficult also because a lot of the priming of the pump comes from federally funded and university funded research. But that priming of the pump really requires there to be a large number of venture firms spreading small amounts of capital around, bringing companies to the fore to the attention of these larger funds, which really don't write these $250,000, $500,000 checks very easily. It doesn't move the needle for them. So what you'd really want in the sector is both a very healthy Andreessen, Sequoia, et cetera, and also a really healthy 10,000 other venture firms that can bring these early companies along and prepare them essentially for meeting the big dogs in the market. So again, none of this is to say that it's necessarily bad for there to be capital flowing to the top of the market, but you really don't want to see a massive divergence where you have a huge washout amongst the smaller firms and just a few firms live, at the top of the market surviving, because that's just not enough diversified risk taking for the innovation sector, which is inherently something where you just want a lot of folks putting bets on.